There's no denying that investing is one of the best ways to build wealth. But with rising inflation and fears of an impending recession, many investors are wondering how to choose safe investments with high returns. There are countless ways to invest, no matter your age, income, or time horizon. From low-risk investments like money market accounts to higher-risk investments like stocks or real estate. Every investment comes with different levels of risk, so understanding your personal risk tolerance is crucial to creating a portfolio that works in your favor. That's where our comprehensive guide to high-yield investments comes into play. We've analyzed and pared down the best high-yield investments to consider. High-yield savings accounts. Best for investors with short-term financial goals. A high-yield savings account is similar to a traditional savings account, but it can pay 20-25 times the national average of a standard savings account. As far as safe high-yield investments go, this is certainly one of the safest. Since deposits are insured by the Federal Deposit Insurance Corporation, FDIC, meaning in the event of the bank going under, your funds are protected. High-yield savings accounts also allow you to access cash when you need it, with a limit of 6 withdrawals per month. While high-yield savings accounts offer a higher yield than standard savings accounts, they won't pay enough on their own to meet long-term wealth goals. Instead, they're best for meeting short-term savings goals like a car or building up an emergency fund. Certificates of deposit. Best for risk-averse investors who need money at a specific future date. A certificate of deposit (CD) is a type of savings account that earns interest on a deposit for a fixed period of time, typically at a higher rate than a standard savings account. CDs are structured by term length, or how long the money must remain in the account before you can withdraw it without penalty. Term lengths can range from a few months to 5 or 10 years. CDs are on the safer end of the risk spectrum, and deposits are FDIC insured. That said, your earning potential is bound by the rise and fall of interest rates. Since your money is locked in for the term length, you could miss out on increased earning potential when interest rates rise. In this case, it makes sense to go with a short-term CD so you can reinvest with higher interest rates in the future. In general, you can earn more with a CD compared to a high-yield savings account, for the trade-off of having your cash locked in for the term length. Series I bonds. Best for risk-averse investors who want protection and stability in their portfolio, especially during inflation. Series I bonds are a low-risk savings product issued by the U.S. Treasury. They earn interest for up to 30 years at a fixed rate and are inflation-adjusted. Meaning in addition to the base interest rate, the Treasury also pays an inflation rate twice per year. That additional rate is based on the rate of inflation. Investors can purchase up to $10,000 of Series I bonds annually and will earn interest for up to 30 years. If you cash the bond within 1 to 5 years, known as early redemption, you'll have to forfeit the last 3 months' interest payments. You can cash the bond after 5 years penalty-free. Series I bonds are an attractive option for those who want to invest as safely as possible. Along with their ability to hedge against inflation, they're among the safest investments available. Money market accounts. Best for risk-averse investors who need access to cash. A money market account is another type of federally insured savings account that earns interest. They're almost identical to a CD or high-yield savings account, except they offer more ways to withdraw money, although you're still limited to 6 withdrawals a month. Money market accounts are best for those seeking a low-risk investment that still offers access to cash when you need it. Like a high-yield savings account, they work well as a short-term savings vehicle for near-term purchases like a car, or for building up an emergency fund. Government bonds. Best for risk-averse investors seeking fixed income and less volatility in their portfolio. When you purchase a government bond, you're essentially loaning the government money, which is used for things like paying off U.S. debt or funding infrastructure spending. For example, when a bond is issued, the investor is paid a certain amount of interest on an annual basis, making them a fixed income security. When the bond term ends, the principal amount of the bond is repaid to the investor. Government bonds are some of the least risky investments out there, since they're backed by the full faith and credit of the U.S. government. In turn, the returns aren't nearly as high as other investments like stocks. If you're investing to fund your retirement or long-term wealth goals, government bonds alone likely won't get you there. Municipal bonds. Best for risk-averse investors who want to preserve their portfolio while generating fixed income. Municipal bonds, or munis, are issued by cities, counties, and other state government entities in order to finance public works projects like building roads or schools. Contrary to corporate or federal government bonds, interest paid on municipal bonds are often tax-free, but not always. Municipal bonds can be structured in different ways, and there are two main categories. General obligation bonds, GOs. These are bonds issued by government entities, but not backed by revenue from a specific project. They might be backed by property taxes or from general funds. Revenue bonds. These are bonds supported by revenue from a specific project, like a highway or toll road. They repay investors using the income generated by that project. Revenue bonds usually carry more risk than GOs, since the payout depends on the income of a specific project. That said, municipal bonds are still less risky overall than corporate bonds. Like most bonds, municipal bond values rise and fall based on interest rate changes. That means you may suffer losses when interest rates rise. That said, they're still one of the safer investment vehicles that also come with tax advantages. ETFs, best for young investors with small amounts of capital to invest. An ETF, or exchange-traded fund, is a basket of stocks that pool in money from investors to buy a collection of securities, which are bought and sold just like individual stocks. They're well suited for young investors with a long time horizon and are ideal if you don't have the time or experience to research individual stocks on your own. ETFs also have a low barrier to entry. You don't need a huge amount of capital to get started. So if you want to begin investing but don't know where to start, ETFs are a good option. They also have the added benefit of instant diversification, since you gain exposure to all the companies in the index your ETF tracks. Just like with S&P 500 index funds or a Nasdaq 100 index fund, if the performance of one company plummets, it can be offset by the high performance of another. The best high-yield investments ultimately depend on your personal time horizon and risk tolerance. Certain investments are better suited for investors who have decades left before retirement, who can also take on more risk and gain higher returns. S&P 500 index funds. Best for investors looking for a low-cost, hands-off investment and stay invested for at least 5 years. If you're looking for investments with high returns, S&P 500 index funds will likely earn you more than any savings account or government bond at the expense of being more risky. Purchasing an S&P 500 index fund means investing in a basket of stocks that follow the S&P 500 index. These stocks are based on 500 of the largest U.S. companies, such as Apple, Microsoft, and Amazon. The goal of an index fund is to provide returns that mirror the performance of whatever index it tracks, as opposed to an actively managed mutual fund. They have the benefit of instantly diversifying your portfolio, since you own shares in a basket of companies in a variety of industries. An index fund is an excellent high-yield investment if you have a longer time horizon. While it's true that stock funds come with more risk than conservative investments like bonds, the S&P 500 index has seen annual returns of 10% on average. And with a longer time horizon, you have plenty of time to weather the ups and downs of the market. Alright. That's it for this video. Be sure to like and subscribe for more videos.